You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome, everybody. This is Buck Joffrey with the Wealth Formula Podcast coming to you from Montecito, California. And today, before I begin, I do want to remind you once again, that if you have not signed up for our accredited investor group on wealthformula.com, do it now if you are interested in potentially seeing some really good deal flow. End of the year stuff specifically will be focused on things that are going to create some tax mitigation. So real estate, hard assets, things like that, that are going to help you not only potentially get a decent return, but also to bring down the amount of taxes that you end up having to legally pay. That's conceptually a very important point because it's not just about the return numbers, right? Like somebody can say it's 10% return, but is that a 10% return that is going to be taxed? Or is it a 10% return that is going to be offset by depreciation? It makes a huge difference, right? So anyway, if you haven't done so and you're an accredited investor, I really do urge you to head over to wealthformula.com, sign up for our investor club, which is an accredited investor group, get onboarded there so you can see some potential deal flow. Now, let's talk about today's show. We're going to talk about, well, I thought it was going to be an interview actually about gold and gold bugs and stuff like that. So I was not necessarily looking forward to it at first, but I realized I was kind of surprised. It was some interesting content that I hadn't heard before. As far as the whole gold thing, I've kind of made myself clear on that. I'm not a huge gold guy necessarily. I believe in real assets, but gold itself has never really had, I think, much luster for me, no pun intended, because it just doesn't really do anything, right? So I'm, if you're going to buy something unleveraged real estate probably is going to appreciate and be a hedge against inflation, but at the same time throw off money. So that's been my own sort of position on that. But gold bugs, they do like the idea of going back to the gold standard, tying the value of the US dollar to fix amount of gold. And on the surface, it might sound like a great way to return to sound money. But if you dig a little bit deeper, it's really kind of full of problems that would likely take us backward rather than forward. I mean, first, let's talk about deflation, one of the scariest economic forces out there. And we've had Richard Duncan on the show multiple times. As he pointed out, I think in the last show, that the gold standard would send us very likely into a deflationary spiral, prices dropping, businesses making less money, wages falling, people stop spending, vicious cycle that can ultimately turn out into a full-blown depression. And that's exactly what happened during the Great Depression, by the way, and gold standard will lock us into this kind of problem again by tying the economy's hands behind its back. Then there's the issue of economic growth. The modern economy moves fast and faster than gold supplies can keep up, right? So by tying our money to gold, we'd basically put a chokehold on progress. Businesses wouldn't be able to invest or hire as easily because the money supply would be so tightly constrained. In short, we'd be sort of stifling innovation, economic expansion, just because there isn't enough gold to go around. The reality is that today's economy, is different from it was 100 years ago. It's far more complex, right? Back when the gold standard was in place. And, we faced massive shocks, through the years, 2008 financial crisis, COVID pandemics, and the government's ability to respond quickly was critical. And you couldn't really do that if we were on the gold standard. Federal Reserve was able to pump money into the economy when it needed it the most and avoided a Great Depression. And that's just the truth. I mean, I'm not a big, debt guy and all that, but that is the reality. Under a gold standard, that would have been impossible, and we'd be stuck watching recessions deepen with no way to cushion the blow. Finally, if you think about this idea of going back to gold standard, it's just logistically kind of impossible, right? I mean, the government would have to buy massive amounts of gold to back the current money supply, which would be chaotic and insanely expensive. It would be a transition full of confusion, and it would tank the economy in the process. So anyway, if you haven't figured out, I am not an advocate for this idea of going back to this gold standard. However, my guest on Wealth Formula Podcast today, she's definitely a sound money person. Her approach is different, and it's I think a very interesting one, which she advocates for like a gold collateralized bond. And her idea is basically to use this, the Federal Reserve's gold reserves as collateral to allow the U.S. Treasury to borrow money cheaply, and then to make an attractive product that would, for investors to potentially invest in, similar to like say TIPS, which are like inflation protected bonds, right? So even if you're not a gold bug, like obviously I'm not, this concept actually makes a lot of sense. And she's going to tell us all about it when we come back from the following messages. Welcome back to the show, everyone. Today, my guest on Wealth Formula Podcast is Judy Shelton. She's a senior fellow at the Independent Institute, former chairman of the National Endowment for Democracy, and former U.S. director of the European Bank for Reconstruction and Development. She's testified before the U.S. Senate Banking, Senate Foreign Relations, House Banking, House Foreign Affairs, and Joint Economic Committee. And she's the author of Good as Gold, How to Unleash the Power of Sound Money. Judy, welcome to the program.
Thank you. Very good to be with you.
So, obviously, just from the sounds of your book, we don't have particularly sound money in your opinion. And so I'm guessing that the most recent Federal Reserve rate cuts, you probably have an opinion on that with regard to the problems with monetary policy.
Yeah, I had some pretty strong opinions about that. I think the Fed tries to overmanage interest rates. There's too much ratcheting up, ratcheting down. And I think it was a mistake to go 8 meetings at the highest interest rate in 22 years, and then suddenly do something so aggressive to do a 50 basis point cut. And especially at a time when in the press conference after making that decision, the Fed chairman, Jerome Powell, said there's really nothing wrong with the labor market. There's really nothing wrong with the economy. And yet that's almost a panicky move by the Federal Reserve. And the labor numbers that came in after they made that decision on September 18th indicated that it really wasn't warranted. And now we've seen an uptick in the consumer price index. So inflation looks like it possibly could be going back up at a time when the Fed has yet to reach its target 2% rate. So I think it looked ill-considered, even based on the Fed's own parameters for making monetary policy decisions.
Well, it certainly I don't know, I'm no economist, but it certainly left me wondering if they knew something that, the rest of us didn't know. Just sort of saying that the economy is generally fine, the labor markets are fine, but then boom, 50 basis point.
Right.
Cut,
well,
right?
It looked that way.
Yeah.
People were concerned in July. The job numbers came in right after they made the July decision. And there was this sense, even some were saying strongly, that the Fed should have an intra-meeting decision, that they desperately needed to cut interest immediately. And the problem is that now looks like the data was off. And so the Fed likes to say they're data dependent, but when the data is dubious, you end up getting decisions that in retrospect were made based on faulty information.
Do you think, obviously, we have an election coming up very soon, and, the Fed has always been, at least self-proclaimed itself as apolitical. Is the Fed apolitical?
I don't see how it really can be. I understand that idea of an independent central bank, but you have people, a dozen people meeting in Washington 8 times a year, unelected, who are in a position to channel financial rewards to one segment of society at the expense of others. That there's a great deal of political power in that. They exercise control over whether the interest rate should be higher or lower. They say they're responsible for price stability. And so you have all these issues that are what presidential campaigns are all about. Right. Those factors, inflation, interest rates. So they're inherently political. And I think it's kind of a loaded question. People say, well, should the president be able to express his opinion? And it's hard to say that anyone should be censored from
Yeah.
expressing an opinion on monetary policy. I don't think you can hermetically seal the head of the Federal Reserve from the president or anyone else. He has a weekly breakfast with the chief economic officer for the White House administration. That would be the Treasury Secretary, in this case Janet Yellen, and he also the head of the Fed meets regularly with the head of the president's economic council, and that would be Lael Brainerd. So here you have two people who held former positions as chairman and vice chairman of the Federal Reserve who are now working directly for the White House. And so it's kind of a revolving door that can go either direction. And I just don't think it's realistic to have, or even healthy to have the head of the Federal Reserve, which is an independent government agency, say that, oh, I wouldn't take a call from the President of the
Right.
United States. Then I
Right.
think you're talking about a rogue agency if we get to that point.
Yeah. Your position, it sounds, is that, in an ideal world, we go back to effectively a gold standard in the U.S. dollar. Is that right?
I don't think that's exactly what I would say,
Uh-huh.
because you have to define what you mean by a gold standard. We
Okay.
had the classical international gold standard, which really doesn't even require central banks. And that actually worked pretty well from 1880 through the beginning of World War I, say 1913. And then we had the Bretton Woods International Monetary System. Other countries were required under that system, which was started in 1944, to maintain fixed exchange rates between their currency and the dollar was convertible at the rate of $35 per ounce of gold, but the only ones who could exercise that convertibility privilege were the central banks of foreign countries. So
Sure.
that would be a type of a gold managed system. What I'm talking about in my book, Good as Gold, is something quite different, but I think it could serve as a marker or even establish a beachhead toward sound finances and sound money. And that would be to utilize the fact that the United States is the world's largest holder of gold reserves. We have 261 million ounces. And since the early 70s, we have been carrying those at a book value of $42 per ounce. So we know that at today's market price for gold, there's already a windfall profit of $700 billion in our gold holdings. Now, we could hold them another 53 years and do nothing with them, or what I'm suggesting is the U.S. Treasury could establish for the first time since Nixon closed the gold window in August 1971, a Treasury instrument that is backed by gold, a specific initiative to set up something I'm calling Treasury trust bonds. They could be as long as even 50-year bonds. They could be issued on July 4th, 2026 and mature on July 4th, 2076, on the 300th anniversary of the signing of the Declaration of Independence by the United States. But as something that people could purchase that would give them the right at maturity to either take the face value of the bond in US dollars or the amount of gold specified as part of the instrument. And that would give bondholders the right to convert US dollars into gold. And I think it would be very helpful for the Federal Reserve to see the difference in the rate of return required on that sort of instrument compared to the rate of return required on traditional Treasury securities. It could even become a price rule of sorts if it forced the members of the Federal Reserve Monetary Policy Making Committee to make judgments about the direction of interest rates based on taking that into account, because that rate would reflect the aggregate expectations of people who held those bonds about the value of the dollar in the future relative to gold. My point is the dollar used to be as good as gold, but it clearly no longer is as good as gold.
Yeah. So I want to break this down a little bit because it gets a little complicated. And so the first point, as I understand it, is right now we have a lot of gold and we're carrying it on the books at a price that's way undervalued. Why are we doing that? We should probably be using it as an instrument to our benefit. Is that right?
It's well, I'm suggesting that it could be collateral. The last thing I would say is that we should sell it. No.
Sure.
Because then that's gone. That money goes down the rat hole.
So we keep it and
specifically.
Right. And then we lend. And then we would lend, the Treasury would lend in the form of bonds.
The Treasury would borrow. The Treasury would be borrowing.
The Treasury would borrow it. Okay.
Yes.
Okay.
And the collateral for that U.S. government debt obligation would be that people lending money to the government, as they do now through Treasury securities, when they buy a U.S. Treasury obligation, this would be a U.S. Treasury obligation. But instead of just receiving their principal back at maturity, the bondholder would be able to say, I would rather have let's say the ounce of gold that is covered by my investment. And they would have that option to be paid off in the pre-established amount of gold versus the face value, which would be the dollar face value of the instrument. That's what I'm suggesting.
Looking from like who this benefits and why, from the investor standpoint, you could feel like, if you invest in these things, you have real value because it's backed or it's collateralized by gold, right?
Yes.
Now, from the government standpoint, help us understand once again what the benefit from the government side would be here.
Well, I'll start. When I served on the transition team, when President Trump came into office after 2016, I was assigned to Treasury as a lead advisor on international financial issues. And even at that time, the Treasury was looking at potentially offering a 50-year bond. It currently offers 20 and 30. But 50 years, like for instance, the French government issues 50-year bonds. It's not that unusual. And it's whether investors are interested in that. They ended up deciding, no, we'll just stick with the 30-year bond for now. But the point is, people are willing to lend money to the U.S. government for 30 years at a time. They're willing to buy 30-year bonds. So and you have to pay interest on that, clearly. Right. So that's a cost of borrowing for the U.S. government. But if a longer-term bond also carried the equivalent of a gold futures contract, that is, it protected the bondholder for the kind of investor who says, I don't want to lose dollar purchasing power that more than eats up the amount of interest I'm getting. I define inflation in terms of the value of gold. That's a surrogate for me, for the real economy. So that's how I want to be guaranteed a certain return. This becomes a much more attractive instrument.
Sure.
And so I think people would pay a premium for that instrument. It's more valuable than just a claim to being paid out in the future in dollars, because there's this guarantee that you will be compensated at your option for what you might have lost in purchasing power if you measure purchasing power in terms of gold.
How would the interest on that be? Would it be calculated as like a return rate on the amount of gold that you purchased then? Because otherwise, if you just look at it as, if you just measure it in dollars anyway, you could still end up losing purchase power, right?
Well, it would work like this. Probably the simplest way would be to think of it as what we call a European bond or a zero coupon bond. So I would say in the simplest possible way, and we could structure it differently, but it would be like saying to someone, what would you pay today for an ounce of gold? And if you said, would you rather have $2,700 or an ounce of gold? I think people might say, I'm indifferent, because that's roughly the price. Yeah. So 2,700 US dollars is equal to gold. But if you were to say, what would you pay today for the option to buy gold for $2,700 in the future, and in this case, far into the future, they'll pay a premium for that, because
Sure.
most people will say, in the future, 50 years from now, would I rather have 2,700 US dollars or an ounce of gold? It becomes laughable,
Mm-hmm.
because the Federal Reserve has a policy of, you might call it built-in obsolescence. They deliberately seek to debase the dollar, devalue the dollar by 2% a year. That is their inflation target, and that translates into meaning the dollar on purpose will purchase 2% less each year, and that's if the Fed is successful in hitting its 2% inflation target.
Yeah.
So clearly, if you took the $2,700 in 50 years, well, $1 in 50 years at 2% inflation would be worth 37 cents.
Sure.
So that would suggest that gold will be worth
So,
a lot
right.
more than
So
the current
again, I
price.
understand it from the investor standpoint. I'm still trying to figure out from the standpoint of the Fed, the benefit to them in lending this out.
I would break it down and say the benefit to the U.S. Treasury, it could
Mm.
be an extremely inexpensive way to borrow.
Yeah. Okay.
The benefit to the Federal Reserve, it could be an extremely informative instrument. It's very comparable to TIPS bonds. Those are
Mm-hmm.
Treasury inflation protected securities. And they came about in 1999 under Treasury Secretary Rubin during the Clinton administration, because investors were looking for some kind of inflation protection. That is, if you are guessing what future inflation will be, that determines how much you will pay for a Treasury instrument.
Yeah.
For short-term instruments, it's just what you bid for them, and then what you get for your principal repayment, that determines the rate of interest. So the less you pay for them, then the greater the return. The more you pay for them, then the lower the return. So this would be comparable to a TIPS bond in that what the TIPS bond provided for people who said, yes, I'm happy enough to lend money to the U.S. government. It's a safe investment, but I don't want to have my purchasing power eat up all my gain from interest. So the TIPS bond compensates using the cost of living allowance, basically
Mm-hmm.
a CPI reimbursement, so that the person gets a certain interest rate, and then they are also compensated for an increase in inflation. And
Okay.
that would be the same concept here. It's just some people say, I want to be compensated for inflation, and my surrogate for inflation is the CPI. That will capture the amount that I'm suffering in
Yeah.
my financial
In your
fortunes because
model,
of
that
that.
CPI is substituted with gold.
Yes, and
Right.
gold becomes a surrogate. For some people, they see it as a symbol of the real economy or other commodities. And it doesn't have to be gold. It could be a commodity basket.
Sure.
But I always go back to gold. A, it's simple. B, we just happen to, as a legacy of having been the anchor currency for that prior monetary system, which finally phased out in February of 1973. It was at that point that the convertibility rate had gone from the original $35 to $42.22 actually, and so they froze it there, and the gold has been sitting in our reserves ever since, and that's why we carry it at that price.
Are you getting any traction on this with, I know you've testified for Congress and all.
Well, it has gone. I have talked with a senator about it. This goes back many years. It was asked of Ben Bernanke if he had given any consideration to this idea. So that's even going back before when he was still the head of the Federal Reserve. It's an idea that actually Alan Greenspan, who was a former Federal Reserve chairman, wrote about in September of 1981 in an op-ed for the Wall Street Journal. He thought it was a great idea for the U.S. to issue gold bonds. In that sense, it's not new. but I am bringing it up in a somewhat new context of how you structure it and saying we should use as specific collateral what we have. And I'm proposing it, and I would say the traction I'm getting is reflected in the book. I just checked Amazon, and it's the number one new release in three categories: in money and monetary theory, in economic policy, and in the category of economic policy and development. And that's true of the hardcover and the Kindle and the Audible. I see that. I might just say that any royalties are going to Independent
Sure.
Institute. I arranged that. My gratification is that it suggests the idea is resonating with people, and I think it's because a lot of people have now gone through an inflationary episode and to some extent lost a little bit of faith in the credibility of the integrity of U.S. monetary policy and the value of the dollar going forward. I see gold flying off the shelves at Costco. I see people turning to a safe haven. It's a happy coincidence for me. I don't talk about gold as an investment, but the fact that it's going up suggests that there is something to the idea that people would like to have currency they can trust. And there's also concern about the BRICS countries, about some countries that are rivals to the United States considering some kind of monetary union. This is a rumor that's been going on, but we do see China and Russia stepping up their purchases of gold. Thank goodness Argentina under Milei opted not to do that. But I think for all of those reasons, it would make so much sense to maintain the dominant reserve currency status of the US dollar by making us the first country with the largest gold reserves to issue an official sovereign debt instrument that is convertible into gold. I think it would say to the world, we intend to be here standing tall in 50 years. We are going to face up to this challenge of fiscal unsustainability, which everyone in Washington acknowledges. Let's start to set up this marker to say that we are going to start balancing the budget and moving toward sound finances and sound money.
What are your critics saying?
I guess my critics go back to the nomination process, and they found it, this was sort of interesting for me, they found it inexcusable to even talk about gold in the same sentence as monetary policy. And I was dismissed as a gold bug, or even more derogatory. I remember a rather cruel Washington Post column that just said anyone who would talk about sound money is using a dog whisper to the cringe right-wing flank. And it's a fringe theory. I sent that column that morning to my long-term friend, Alan Greenspan, who I'd known since 1990. When he sent me a note, he'd read my book on the bankruptcy of the Soviet Union. And so I regularly talked with him, including during the nomination process. And I sent him that column with a note, an email saying, there seems to be a certain hysterical antagonism against the gold standard. Well, those are the words. I was quoting him from an article he wrote called Gold and Economic Freedom in 1966, published by a compendium of essays on capitalism by Ayn Rand. And he emailed back, if gold is such a worthless metal, why does the U.S. government hold so much of it? And also the other major governments of the world. And I thought to myself that these critics, these pundits, really didn't understand the role of gold, not just throughout mankind's history, but specifically the U.S. history and these episodes when we have had some kind of link between our currency and gold, when we defined our currency in terms of a precise weight of gold. those were very stable periods. They included economic growth, increases in productivity, technological advancements, and it also provided for a level monetary playing field, which I think is the only appropriate foundation for free trade. I'm very much against currency manipulation, and I think it's vital to have a system that allows American manufacturers to compete on a level international monetary playing field.
So, but what's a little confusing to me is you're really not, I mean, from what I gathered from what you just told me, you're talking about a bond. You're not really talking necessarily about going to a gold standard. I mean, when you start talking about gold standards, then you get arguments of, okay, well, you'd have huge deflationary pressures, the constraints of gold in terms of economic expansion, international trade and currency instability, things that people bring up when you talk about the gold standard. But that's really, as I understand it, not what you're talking about. You're talking about creating an instrument that allows for, cheap borrowing but from the Treasury and maybe a good product for investors. So am I missing something?
No, you're stating it exactly properly.
Right.
And that's what I say when people try to accuse me of something or a gold bug. I honestly feel that most of the time, not only do they not have the benefit that I have had for decades of being able to talk about monetary policy and the role of gold with people like Paul Volcker and Alan Greenspan or Robert Mundell, who won the Nobel for his writings about the role of gold in prior monetary systems. I see people who really don't understand it, not able to state what they mean when they say gold standard. Because it is just what you're saying. My initiative would be this particular offering. I'm trying to do something specific. I think it would help focus attention on the deficiencies of a currency that is deliberately devalued every year compared to gold as a monetary anchor. But I would say right off the bat, Federal Reserve notes, which is a currency issued by the Federal Reserve, are already at 2.4 trillion. So obviously you couldn't, even with 700 billion, which is a huge amount of money, you couldn't even make those convertible into gold. So if that's their idea, that it means that the government stands ready to convert currency into gold, that really doesn't make sense. Besides, 70% of those banknotes are circulating outside of the country. So that's not what I'm talking about. What I'm talking about is setting up this marker and bringing attention to it. In the same way, I think TIPS bonds originally were conceived as a way to let the Federal Reserve get a sense of aggregate expectations about inflation. And that should feed into their consideration on interest rate policy. I think this could be every bit as powerful as that. But even more, I think it could do something fundamentally important. The lack of any kind of international monetary system today, I think, is a real deterrent to the principles and even the concept or rationality of free trade. And we see that now we're looking at tariffs as a way to rectify some of the unjust trade practices that are carried out. If you look at the 1930s, and of all things, I'm a monetary historian, you see that it was this very damaging syndrome of countries devaluing their currencies, and then the reciprocal action was to apply tariffs to try to make it even again, to make up for the unfair trade advantage they got from devaluing their currencies. I now think that if we apply tariffs, we will see countries devalue their currencies even more. And you're back into that downward spiral, which is not healthy for the international economy. And certainly the 30s were very destabilizing and ended up with a war, a major world war. I just think that we would be much better off to look seriously at the need for international monetary reform. And if the U.S. showed the leadership of starting to have this instrument that establishes some backing for the US dollar in terms of gold on this delimited basis, as you pointed out quite rightly, over a specified time period for a particular instrument, but nevertheless historical in the sense that for the first time in 53 years, there is some kind of link between the US dollar and gold. What if other countries did the same? What if they issued sovereign debt with some kind of a convertibility clause in the future? You could begin to see a fixed exchange rate. It would be inherently fixed. That would, because it would ultimately converge with all of these debt instruments issued by other governments, all being in the end worth some measure of gold, a specific amount of gold. When you have gold as the common denominator, it becomes the benchmark or the reference point. And then I think you start to focus attention on how other countries have debased their currencies even more than the dollar against gold. We have a dollar that is very strong, partially because the central banks of other countries compete against us. They carry out the currency manipulation by having a lower interest rate than the United States. I mean, you would think that our credit rating and our power in the world and the size of our economy would enable us to borrow at cheaper rates than say, Spain or China or Italy or Portugal. But the European Central Bank, for example, their policy rate, their target interest rate is 3.65%. Ours is 4.9. So that begins to tell you that our exporters are at a disadvantage. And in that sense, it's true. You can go off on the other argument about reciprocal tariffs. We should at least, I think, not have other countries apply tariffs that are higher than the ones we apply against their products. But there are some things that are going to be hard to correct for. Cheaper labor in some countries, or trying to make everyone have the same environmental standards or the same human rights standards. I'm for those things. I think they're hard to enforce. But you really could say we can measure how your currency has been devalued relative to this common reserve asset, relative to gold, compared to ours. And then that's the beginning of saying, you see, you are practicing an unfair trade advantage. And so we are forced, the natural retaliation is to impose tariffs.
Yeah. Makes a lot of sense. Judy, the book, again, it's Judy Shelton. The book is called Good as Gold, How to Unleash the Power of Sound Money. Judy, thanks so much for being on Wealth Formula Podcast.
My pleasure. Thanks for having me. Enjoyed it.
We'll be right back. Welcome back to the show, everyone. Hope you enjoyed it. I always like to, when somebody comes up with an idea that actually makes sense and that is practical, and I think that's what Judy Shelton has done. So, interesting idea. I hope she can get some, I hope she gets some traction there, because I think, why not? And the other thing is, if we have a lot of gold sitting there and we're not using it for anything, Federal Reserve isn't using it for anything, it certainly seems like a good idea to do from my perspective. Anyway, hope you enjoyed it. Once again, just as a reminder, if you've not joined our accredited investor club and you are interested in doing some tax mitigating investing by the end of the year, and you're an accredited investor, go to wealthformula.com, sign up for our group, and get onboarded as an accredited investor. That's it for me on this show today. This is Buck Joffrey signing off.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.